Well, welcome to the Stock Market Neophyte Show. It's a noon again on Friday already, and as you can see, Gary's down there taking a leisurely vacation because he's made so much money in the market. He says, "I got to go spend some at the Leaky Tiki down in Orlando with his family." I saw pictures. I'm mad. I'm mad because it looked like a lot of fun, and I wasn't there. So, Gary, how you doing?
Yeah, you have been here before. With
Yeah,
me.
I've been there. We've been there. We used to go to golf trips there, and
Play
we
golf.
go over to Inverness and play some golf there. Hey, we got a special guest today. Well, we got two special guests. Actually, Gary Jr. there is on second time on our show. We've only had like 5 episodes, so he's like a regular already. And then we got my friend Spiro Heraklianos. It's the Greek with the plan. And he's going to show us some things about options today. So hopefully we're going to get through all this and it's going to be good. We're going to have graphs and charts and all that. And of course, we're going to talk about Boyle. And before we even get started, I've got to brag. Okay. So Gary, remember when I had my $1,000 challenge? I got it down to what, $700 or whatever. Guess what? Old John Boy came back. I'm at 948. So I'm going to go ahead and play my video for my victory. I cashed out and I didn't put it back in the market because I didn't want to screw up before the show. So basically I made it on, I think DNA. I bought it at like 78 and sold it at 102. Ta-da! Nice. That was a score. Yeah. For, all that. So I'm playing my victory thing here. And on the other side of this, we're going to bring Spiro on and get to it because he's got a hard stop at 1 and we're not going to go that long anyway. So here you go.
You are the winner this week. Way to ride the bull.
Yep, I win. I didn't ride the goat this week. It's unbelievable. So, I was supposed to have Spiro on here. There he is. Yeah, I didn't push the right button. Sorry.
Hey guys, videos are kind of like the stock market. Last week was the goat. This week's the bull. Nice.
Oh man, it's been. I just woke up Monday morning and I was like, I sold off some stuff. Remember, I said when Mondays are good, Tuesdays are bad. I sold a bunch of stuff on Monday, woke up Tuesday morning and it was bad. And I'm like, I bought everything. I was buying stuff like Zsa Zsa Gabor and Fifth Avenue Saks, man. I was just buying it up. And then, it's stuff's what. So it's a better week for me anyway. I don't want to sound too excited because you know how the market is. Stay even keeled. Don't get excited about things. So Gary, how are you doing? Are you enjoying the Florida? Well, I say Gary Jr., not Slim Trader Gary.
Well, you can brag about locked profits.
Yeah.
We locked some profits in today.
Yep, that was
Boyle, clean.
Gary froze up on me.
There's a little lag. So bring in the guy. Let's do it.
Yep. All right, Spiro, take it away. So what we're going to learn about today is options, right? Option trading and how you do this. And I put on our show, what's a put? And so first of all, just tell us a little bit about option trading. Well, you can say something about Spiro the Greek. So.
Well, I don't think people care much about me other than
I do.
That we're friends and appreciate this opportunity to have a debut on one of your programs.
Yeah, I got the Bullwinkle up there just because I feel like I pulled a couple rabbits out of my hat this week, so I put that one up. So
I first heard of options in the mid '90s, and it was presented to me as something scary and risky, and you got to be careful with that stuff. But I also heard that it was a way to make decent returns on investment. So from that little seed of fear in my early or late 20s, I should say, I didn't pay much attention to it. And then maybe about 5 years ago, I got involved in a club where we were talking about investments, and there was a guy there who was all about options, and he presented his spreadsheet, he presented his results, he was making buku bucks, and I sought him out to figure out what he was doing and what was different about my impression. And he explained it in a way that made sense to me, and that's the approach I'm going to take here to talk about what options are and just give a little bit of a look of how to do it, and then we can see if you want to dig into it a little deeper. But what options are is a way to invest in a security. They call it an underlying, but where you're not actually buying the security, but you're buying or selling an option to own or sell the security. So even though you should have the funds to cover the purchase or have the stocks to sell the security, you don't necessarily have to put the whole thing at risk. So I think the easiest way to get into it is just have a quick discussion, if you could share my screen there, about what the mechanics are. So, we're typically familiar with looking at, charts like this and looking at all the fundamentals. And, I heard you guys talking about how you're buying and selling. So you set little thresholds of buy and sell. What I've learned over the last few weeks listening to you guys don't put in limit orders. You guys just do spot buys, get in and out. That's great if you can keep an eye on it. But most traders do limit orders, right? They say, okay, well, the price is sitting at about 12.11. I'd like to buy it at 10 for whatever reason. Whatever reason you have, you say, I want to buy it at 10. But there's, when you're doing a limit order, there's no expiration date. You put in good to cancel, something like that. You don't make a premium. And then when the price comes down to 10, you buy it at 10, right?
Yeah.
You put in a limit order at 10, you buy it at 10. And then you have to figure out when you want to sell it, okay? So let's say you want a 10% return on your investment. That means that you're going to sell it at 11. You put in another limit order, you sell it at 11. Whenever that happens, it happens. You don't make a premium. You sell at 11. Guess what? You made $1 per share. Does that make sense?
Yes, that makes perfect sense.
Okay. Now, when you're buying it, when you can do the same thing, same mechanics, but using options, the bid price is at 12.11. Your desired strike price is at 10. Here you set an expiration date. You say, I want to buy this. I'm willing to buy this at $10 by the 17th of May or on the 17th of May. And by just making that request into the market, you're going to make 89 cents a share on that. This is something that I did just this early this week after you and I talked about this security called Agent. Okay. You're going to make 89 cents per share just for offering to buy it at 10. So now your cost basis is not 10, it's $9.11. Does that make sense?
Yes.
Okay.
So basically, you get that premium right away, right? It goes right into your account.
You get it right away. So now you want to make 10%, same desired return on investment. You say, okay, I want to sell it at 11. I set another expiration date, 21st of June. You need to kind of wait a couple weeks, right? Now, I don't know what the premium would be in this case, but let's assume the premium is 0, okay? You sell it at 11. Guess what? You just made $1.89 return on your investment.
Wow. Yeah, that makes it a little more, that makes it more appealing. But what happens if it goes to, if you want to buy it at 10 and it goes to goes to 6, or like in this case, just a week ago, this thing was $4.95. So.
Well, yeah, there's all kinds of caveats that we can get into, but let me just throw in a little thing. So let's just say let's just say that somebody's offering you a 10-cent premium. Can I do that here? How come my mouse isn't working or my keyboard's not working? Anyway, I got enable editing. Here we go. Sorry about that.
Minor details.
There we go. All right. How come I can't expand that window? Always something, right? With technology.
It is. We're watching it in action.
All right, so let's say I want to make a 10% premium. Now my profit, my ROI goes to $1.99. All right. So yeah, to your point, what if it goes down to 6? Well, guess what? It goes down to 6. You had to buy it at 10. Okay, so that's what the definition of a put is.
Oh.
Okay.
So somebody actually...
I said I'm willing to buy it at 10. Somebody said, okay, I'll give you that opportunity to buy it at 10. If it goes to 10 or if it goes below 10, I get put that stock. It's put to me. I have no choice but to buy it at whatever price it closes at.
On May 17th.
On May 17th. That's
And
why
is there like a time period you set up even like at noon, or is it just during that day?
It's at close.
Oh, it's at close. Okay.
Yeah. So that's what the definition of a put is.
Ah, okay. So that's
okay.
So if you're paying attention, folks, that is the name of our show. What is a put? There you go. See, if you pay attention long enough, you'll figure it out.
It takes a little while to get there. So this what I'm doing right here is called the wheel. It's called the wheel strategy. So like here, when you're doing these limit orders, you're kind of agonizing, when do I sell? Well, if I get put this thing at 10, or if I get put this thing at 8 or whatever it is, I'm going to go ahead and try to sell it right away. I'm not married to this thing. All I want to do is make premium. Okay.
You want to make more premium than you lose if it goes low.
Right. So if this thing does not hit 10 by the 17th of May, I take this 89 cents per share. You have to buy in groups of 100. So that's $89 of premium. And I could just walk away, no harm, no foul, etc. And I can redo it again. I can do it over and over and over again. But if I get put, then I go on to what they call do the call, which means I'm offering this for somebody to call it away from me, to take it away from me. Okay. And depending on how bad the market is, because I've got some losers, I've got some dogs. Depending on how bad things get, you can keep doing this rinse and repeat. You can sell put. Oh, I got a put. Okay, now I'm going to sell a call, and continue to make premium by offering to buy or offering to sell the underlying. Are there any questions about that?
No, there's not. I've got Gary on mute because their background noise is pretty bad, and I don't know how great their delay is. But Gary, do you have a question?
Well, can you, let's just say for the audience, a put is assuming the stock's going to go down.
Correct.
Okay, and a call is assuming stock's going to go up.
And it depends on what side of the trade you're on. Okay. What I'm focusing on, and the people in my group are focusing on, are selling puts and selling calls. And this is the mechanism that you use to do that. Okay. This is called the options. This is called the options matrix. So we're looking at AGN. You can see how it's been doing, right? Over the last week or so, it's been climbing up, right?
Oh yeah, that thing is like
right.
Made some money for some people.
Right. So I'm feeling pretty confident that I'm not going to have any risk by May 17th. But like you said, this thing can turn on a dime, right? Like it did here.
So you've got it in at $10 for
right.
Yeah. It seems like it's staying. There's something cooking with them, but no. As me and Gary say, only they know what it is.
Right.
Because that thing went up like a rocket. I mean,
right.
It took off.
So this is the Thinkorswim. This is the Thinkorswim platform. You can see I have a position here at $10, as you said. Okay. But if you were to do this, let's say, let's go to the next option would be the 21st of June. Okay. So if you want to do this now, you would say, okay, it's sitting at 13.29 right now. Can you see where I'm hovering?
Yep.
Okay. I want to buy it at 10. All right. So here we go. By selling this put, Okay. I'm going to make $1.12. I could make $1.12 a premium. So that's $112 right there. Just by
For every share.
selling. Go ahead.
For every share.
Yes, and you have to buy in groups of 100. That's the only thing that differentiates the options to a true market limit, because you have to buy in groups of 100. Whereas with just a limit order, you could buy 1, 2, however many you want. Okay. So this is how you would go ahead and execute a trade for selling a put. You just come in here, you pick which one you want, and there's all kinds of data. This is like the probability of it happening. So this says that there's a 20% chance of this thing going down to $10 from where it is now. So you can kind of gauge, and then you got your return on investment, your return on capital. But over here is the call side. So let's say, as I said, I want to sell this thing at 11. Let's assume I get put. Right now, 11 is going to be in the money. So I'm going to come over here and sell it. You know what? I want to sell at 14. Okay. And what this is telling me that there's about a 50% chance that it's going to go to 14 by the 21st of June. And look at that. I'm going to make $2.50 of premium just for saying, hey, I own this stock. I want to sell it at 14. Who wants to buy it from me? John says, I do. I said, okay, John, give me $2.50 a share premium just for the opportunity for you to buy that from me.
Wow. And I would buy it too, because I'm not that smart.
So that's what's called the wheel strategy. You sell and get put over here. And then when you do get put, you come over into this quadrant and you sell a call and you make premium on both sides. Now,
So,
as I said, we can go into some ugly scenarios where, like, I'll just confess to you guys, I did Zoom. I did a call. I sold a put on Zoom for $350 a share. That was like a year ago when Zoom was flying high.
Yeah.
The day after I bought it, there was a lawsuit announced, and the thing just started dropping like a knife. And right now, Zoom is sitting. Who knows where Zoom is sitting?
I do not know, but I can find out. You probably do.
If I was home, I could check it out.
Here we go, right here. So Zoom is sitting at $65 a share.
Oh my goodness!
Yeah, that's 100 times 300.
And, right.
That's a lot.
So if I can't give this thing away because I can't find.
You're not even on the chart.
Yeah, I can't find an option to sell it anywhere close to 300. Here's 90, and nobody wants to do it.
Yeah. So you're stuck with that.
And there are other ways to leverage that.
Go ahead.
Huh? Yeah.
Let's go out a year. Go ahead, Gary.
Again, I don't. And there are other ways to leverage what you've lost to start doing.
There is.
What's the name of those?
Well, if you wheel in the wheel strategy, aren't you going to do the other side now, like where you're selling calls against? I assume you got put right.
I did, but Gary, keep in mind, I got put at a $325. Here I am, a year out, March of 25. I can't find anything close to 325. The best I could do is find $90, and that's a year out.
Yeah. So can you make your own up? I mean, could you not put one in there, and wouldn't it show up?
No, this is what the market is telling you is available.
Okay, so you can't even.
There are strategies. There are strategies to alleviate the problem. Think about dollar cost averaging. Since it's so low, right? I can come over here and I can invest more into Zoom, buy it, sell calls at a lower price, sell calls here at 50. So here, let's go here to $60. Okay. So go buy a couple hundred shares at $60 a share. reduce my cost basis, and then try to come over here and sell a call at 90, which is typically what you would do when you're buying on the open market as well, the first thing.
Right.
So you can apply those principles. Yeah, you can apply those principles to dollar cost average, still make premiums, but now you're just increasing your risk, your exposure to this one security. So I'm kind of stuck with this one. I'm bringing it up. This is my classic dog.
Goat. Hold on. Here, let me take care of this for you, Spiro. Let me play something. Here you go. Here's for Spiro right here.
The stock you picked was hideous. It was awful. Now you must ride the goat.
I'm glad I could transfer that over to somebody else.
Yeah.
Thank you for sharing, because all over the internet, all you hear about is all the winners, and the audience needs to know that this is a risky business for sure. But
right.
Oh yeah.
So they can learn what I've known people that were up hundreds of thousands of dollars, and before you knew it, they were below where they bought in. So share with us, because I've been where probably your answer is going to be. What? Obviously, you look back and think, man, I should have sold right away. I wouldn't be as deep in the loss as I am now. And we're all trying to figure out when to sell, when to buy, and all that. But so many people have lost all their profits go away, and then they've let their reserves run to the extent. So, just in your opinion, what should have you, even hindsight now, what you have done and advised to anybody that's listening?
Well, with Zoom in hindsight, I shouldn't have been as greedy because I was just looking to make profit. I've been using Zoom for 10 years. I said, oh man, this is going to be around for a long time. Ooh, they're offering a good profit. I'm going to cash in on this. And what happened was the thing dropped so fast, I wasn't able to react. I wasn't watching it. I was busy with my other areas of my life. And it just came down so fast, I just totally lost control of it. So typically, the tenets are, don't get into something that you don't really want to own. Okay?
Yep.
Because you don't want to regret getting put. Okay? You should own it for some reason that you want to own it. Hey, John, do we have the banner?
Oh, yeah. Spiro's always reminding me, we got a banner. There it is. Yeah,
there we go.
It's like, let's see it.
Yeah, so number one, don't sell an option or don't buy something that you really don't want to own. Okay? I was a little greedy. I liked Zoom, but I really didn't do my homework. And then in other cases, you can buy out into the future so that you can then make some adjustments. So this gets a little more advanced where you can roll something. So if things are going and you're nearing that expiration date and things are looking like it's going to come down to your strike price, you can say, guess what? I want to extend my offer another week or another 2 weeks. And there's ways that you can buy back the put and then sell another one. And then you make the difference in those premiums. That's a little more complex, a little more advanced than what we probably need to get into today.
So I have a question. So if say you don't get, so nobody picks up your option, you don't get put, it just goes away and you keep the premium, right?
Correct.
Okay.
That's the goal.
that is the goal, to make an offer that nobody wants. I'm pretty good at that. Reminds me of some of the girls I dated in high school, I tell you. But so that makes somebody laugh. But so basically, you could extend this your date if it's going bad and you think it's going to go up. But I would think if it's going bad, you just want the pain to be over. You wouldn't want it.
Well, it depends. So these are some of the trades I have going on right now. So here's my agent put. Okay. Here's a put for Lycee. This is a battery recycling, refurbishing play. So I can come over here and say, all right, let's see where Lycee is. Let's go to Lycee here.
Lycee.
Man, it looks like
Lycee.
It looks like the Cookie Monster smile.
Lycee.
Gee, that thing's
Okay. So I've got so it's sitting at 71 cents. So see, I'm at risk here because I said I'm willing to buy it at $1. So it's below $1. So now I'm going to come over here and I'm going to create a rolling order. I'm going to sell. So now this is what this is telling me is if I want to extend this thing till June, I'm going to make 5 cents a share just by asking to push it out. So this is a strategy that you can use to say, hey, I don't like the way it's going. I want to give myself some more time. I'm going to come in here and roll my order. Okay.
I think they should call that procrastination instead of a roll.
Well, you're rolling it, right? You have an order and you're just rolling it over.
Yeah. Just delay of the pain.
John, you're going to bring some new trading terms to the whole.
Oh yeah, I got some. Oh, by the way, Boyle's up to 1450.
Oh, man, I spoke late early.
I know, but you never know, right? Never. What's that say? What's Owen say? It's never. You never can take too much profit, or never get too little. I don't know what the saying is, but anyway.
Green is good. Yeah.
Yeah, you can't lose taking profit. That's what he said. You cannot lose money taking profit.
There you go.
That's our saying, along with buy low,
sell high.
Sell high. All right. I want to sell higher. So as you guys can see, I've got about 8 or 9 trades going on that I've got to keep an eye on. So I've created a spreadsheet. It's probably not as sophisticated as Gary's tool, but I got to keep track of my stuff somehow. So here's my spreadsheet where I keep track of everything. So everything in green are the orders that I've got going and the expiration date. I update it every week and just to keep track of where I'm going. So here you can see the stuff that I was into and some of the profits that I've made.
So yeah, let's talk about the agent, the one that we did last week when we talked, because we talked right after the show pretty much. I ended up buying Boyle at 13.13 and I sold it at 13.64 on the next Monday. And then I bought it on Tuesday at 12.90 and I just sold it this morning at 14.19 and 14.17. And I was just like, as soon as it got above 14, I'm like, I'm getting nervous. But that was pretty good. So I ended up making about $1,400, almost $1,500 on that go around, plus another 312 before. So it's not bad. But I'm telling you, that thing is read the banner at the bottom like 4 times if you want to get into Boyle. Because when Gary first told me about that Boyle, I'm like, man, there's no way I'd ever trade this. It's too crazy. But here I am.
Yeah. I ended up with 1,200 shares, averaged down to, I think the last 300 shares I bought was at 12.85.
Oh, yeah.
So my average price per share ended up 13.55. And so this morning, I put a sell in at 13.97.
It went right past that like it was standing still. I mean, I looked and it was like milling around, 13.70. And then I looked again, it was like friggin' 14.13. I'm like, what happened? I blinked. And so it's crazy. It's weird.
Well, so here's another thing. Here's another thing that you could do. Like, let's talk about agent.
Yeah, this is the one you did last week. So you were able to.
So I'm tied into this thing till the 17th of May. I made, let's just call it 90 cents per share. Let's say I'm listening to you guys and I'm hearing something that I don't like. I can go over there and buy this back. It's going to cost me 45 cents. So basically, by telling the market I want out of this thing, I'm giving up 50% of my premium.
But you're out, right? So you made 45 cents.
Yeah, but then I'm out.
You made
Yeah.
45 bucks. If you bought 100 of something, you made 45 bucks.
Right. So you can exercise that option as well. Just like you can get into a stock and then decide to sell it, you can get into an option and then decide to sell it.
Yep.
And
So
then you just have to,
so on this one, you're in good shape because it's still higher than what
Right.
but somebody actually put this. So they're going to make you buy it at 10?
well, not until the 17th of May.
Okay, right. But you're
You know,
going to want to buy it because it's at like what's it at now? It's at agents is at 14, no, it's at 1302. So you got some room for something to go wrong.
Well, yeah, but actually I won't buy it. The option will expire worthless. Nobody's
Okay.
going to sell me a $14 stock for
Okay,
$10.
so you don't. So until you get called, that's what. So the put just means you're putting it out there, and the call means that somebody's actually picked up the ball and running with it. So you're. So
It depends on which side you're on. Yeah, it depends on which side of the trade you're on.
Right. So once they call you, like, so what's your next one down there? You got called on it. It looks like.
Well, this is a call. This is a call that I'm saying I want to sell. I want to sell this.
Right.
I'm offering for somebody to call it away from me. Call it away from me. Take it.
Right. So they get 15 cents on the dollar for doing that, or on the share.
I got 15 cents on the dollar for offering it.
Oh, okay.
And
if they end up picking it up, then you get 15 cents?
I got the 15 cents whether they pick it up or not.
Oh, okay. Well, okay. Yeah, I see. Oh.
And for the folks out there listening, don't even, you may be saying right now, oh, there's no way I'll understand puts and calls. But one day it'll sink in. You just have to keep listening. Don't.
You really got to understand it. That's right.
You got to understand it, and it's not that hard. If I can understand it, you can understand it. But it, depending on what level of math, and math kept me out of college. But
yeah, I'm a creative type myself.
So you can get it, but do not trade options until you understand them. Yeah, you can click some buttons, you can lose your whole account by mistake.
Right. Well, when we were talking about, Spiro talked about the lawsuit and it just dropped away. Well, that 1 week I lost probably $30,000 in, because I had a lawsuit and it just everything that I had made, I was back to square one in pretty much 3 days. So, it's the news of these stocks that drive them up and down. IBM, another example, they were going to buy this other company for $4 billion or whatever. And the other stock was good. So I went and bought it and I made a little bit of money on that, but IBM dropped so bad. It just, sat there and watched it just go, do, 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 do. Just watch the money go out of the account. It's like, this was fun.
Yeah.
Well, if you know puts and calls or options like Spiro does, would you agree to this statement that, you're not risking as much money, but the potential is still there? Where I buy 1,200 shares of oil, I got a lot of money on the line.
Right.
Would you agree with that? Yeah.
Well,
options is something to look for sure.
The other way to look at it is, even though I'm not actually giving that money away to own the stock, I got to have it in reserves to cover it in case I am put.
Right.
Yeah.
You can't just fly out there.
This is called the buying power. So,
or you're going to have to come up with it.
Right. Yeah. So you have to be able to cover it. So it's called a cash secured put. Now, some people have margin accounts where they actually borrow money from the platform. In this case, this is Schwab, Thinkorswim. They borrow money at a lower percentage point to go leverage that money to do this stuff. And if something goes really, really south, then you have what they call a margin call. So the trading platform says, hey, I loaned you this money. Your stock is in the toilet. there's no way we see you recovering. You got to pay us what you owe us right now.
They call it due. Yeah.
Right. Right.
Yeah.
So,
when we see the market sell off, which we have not recently, but I mean, I've seen it sell off, and about 4 or 5 days into the sell off, then the talk on the market is, oh, there'll be margin calls. We're not done with this selling because there will be margin calls and it will go down even lower because unfortunately people are getting hurt bad by their decisions they made.
right.
So,
Jumping out the window type stuff. That's why you hear that. That's why they really got rid of the World Trade Center, because the stock market guys kept jumping out the windows, right? It's like, it's crazy. But I would say that good advice would be, don't invest money that you can't afford to lose. It's sort of like gambling, I mean, it really is gambling. It is because as neophyte investors, which we all are, I'm probably the least experienced out of this. We are the last to know what's going on. It's like, 3D going up 20 cents last night after it's been at 30 cents. It's been beat down. And all of a sudden it goes up. Why? Just because there's a reason somewhere. There's some news, there's something that's going on that's going to bring it up. And same thing with, something going down. Somebody's got wind of, a lawsuit or something. And then next thing you know, it just goes down. So it's definitely more risky for us.
I think Gary Jr. calls it the whales, right? It's the whales that determine what's going up and what's going down, right?
Right. And that's they. And then I don't gambling. I've heard that for years. It depending on how you do it, it could perceive as gambling. But the point is, if you go to Vegas and you put $5,000 on the roulette table, you're either going to lose that $5,000 or you could get lucky and win. When you put, 20 grand down on a stock, you have the option to get out. If it's going against you, you have a stop loss. Say it's $200, then get out, and you have that. You've only lost 200. So it's not quite like gambling. There's a technique and knowledge to know when it comes to trading.
Yeah, it's not gambling, but it can be if you don't do your research or whatever. You just relying on luck and trying to figure some stuff out. And we're not privy to all these companies' dealings and whatnot. You can get a sense for, like Spiro got into Zoom when Zoom was like the stuff. We had a bunch of .com stocks in the late 90s that people made a fortune on, and then now they're non-existent. So it's a tricky business, and it's like babysitting kids. You can't take your eye off of it for 1 minute. That kid will be tearing something up or pooping on it, one of the two. So, you got to do that. Let's see. Let's do a boil check here. See where we're at. It's at 58 now, 1458, Gary. Awesome.
I lost 50. Another 50 times 12, another $700.
Yeah, what the heck? You can go buy you a couple pina coladas and call it even.
Right.
So, all right. Well, we've sort of done this. We're going to have a quiz next week on this, and Gary Jr., we want a tutorial on follow the whale. We want that coming up because I think that could be interesting. We need to get you some more subscribers on there and learn how to do that. I want to see. I'm ready to get into this option trading too. We'll see how that goes. So,
well, let me ask Gary. Let me ask Gary a question. So, Gary, do you think that your app, your platform, could be useful in trading options?
I think it could be useful if you're truly just trading options, like day trading options. I've got some friends that do that. They'll do 0 day to expiration, 0 TD. They'll be trading that.
Right.
So it does help if you are use the well trail indicator to show, what the wells are doing. Base your options trading moves on what the wells are doing, just like you would with your stock trading. So I think it would be useful. But if you're doing like the whale or the heel strategy, using the whale trail indicator with the wet heel strategy might be challenging.
Okay. Well, work on that for when we get you on next time, when you're back in at your homestead and not out at the pool with some really shaky cell phone service there, which if you're investing in AT&T, I'd sell it. So I put up here on the board, I put up my account. I'm awful proud of this. I was able to make about $150 back on DNA, Gary. DNA is my one that I went to. I just friggin' put everything in a DNA at like 70 something and it went up. And
that thing.
It was a good one. Now it's back down, but it's
Around.
back about half up. So it's but when you take a risk on a penny stock, the gains are good, but the losses can be also is not that good. So it could go out of business type of thing. So, but I'm wanting to get over the 1,000.
Thank you for coming on. A
Great presentation.
Great presentation.
Yeah,
Well, thanks.
That we could go with it, and hopefully we can have you on again and teach people how to do this. It's a good thing to know for sure. Yeah.
Well, I was telling John we can open up a paper account, which is a simulation account, if you want, and have some fun with it. We can put $200,000 in there and start trading it and see what happens.
Oh yeah, the paper challenge. That's what we call it. Yeah, it's a $1,000 challenge, which I really proved the point that I know what I'm doing by taking it down to 700. I thought that was impressive. I picked Spirit Airlines. Spiro, our situation with Spirit Airlines. That one didn't work out. Then I bought Mark Ford's at its peak, and that didn't work out. But we got some of it back. But it's when you're only dealing with $1,000, it's tough to get back what you lost because you don't have a lot of capital to put back in the market. So, but yeah, so it's interesting. So let me get rid of this. There you go. So that was my proof of my winnings. So let's see. We got time for doing the Magic 8 Ball. Let's see.
Hey John, just one comment on Spirit Airlines. I sold two put options. Never got put. I made $149 just by offering to buy it, and the options expired worthless. I made $149, and I don't own it.
Yeah, put that in your Zoom account. You're coming back, baby. I'm coming back. The thing. So this is my question: is the market going to continue to go up this next week? So when we come back next Friday, are we going to have an up week? Let's see what the Magic 8 Ball says. It is decidingly so. There you go. The 8 Ball has spoken. The market will increase this week. So you can take that for what it's worth. Read the bottom ticker and act accordingly. So Spiro, thanks for coming on. Gary, I'm not real mad at you, but I'm glad you guys got to spend some family time. I saw Tori's pictures and you guys, I'm surprised you didn't get thrown out of the pool, but you're all good. So, all right. Well, that's going to do it for the week. I can take the banner down because we're done, with our show here. And we'll see you again next week at noon, and we'll go again. So
don't forget to use your sunscreen.
Yeah, don't free. And I do have the new ending on here. It's the same video, but at the ending, it's got the spring Chateau de Marseille at the very end. So here you go. We'll see y'all next week. Thanks for watching.
So you're new to the market and you're watching these market shows and talking to some of your friends, and maybe you listen to one of them and they say, hey, I got this great stock tip for you. Just get on board here and we'll ride this thing together. I'll show you how to do it and I'll teach you a few things. And you're like, okay, come on and get on. And then you get on there and then all of a sudden the market starts going. You invest this money, the market starts going and it's going, and you're like, I don't know, I'm feeling a little bit shaky about this deal here, and then the market starts going up and down, and you're like, hey, and then all of a sudden the earnings come out and it's like, oh, your friend says, oh well, sorry about that. I really thought it was a good deal. I just I'll talk to you later. And then you're sitting there, you're holding on to the horns.